Okay, so check it out, folks. We're gonna really talk about the power of infinite banking and how to utilize life insurance, or specifically an overfunded life insurance policy, to really kind of change the tempo of how your money works, and being able to do this and take advantage of things that are on deep discount right now without looking over your shoulder. So really, let's get into some policies right now. And don't buy your mom's, if she is a baby boomer, term policy. Term, you pay a set amount per month. Then if you die, your family gets a payout. It's cheaper overall, but you do not keep the value of your premium payments over time. Conversely, whole life, these policies are more expensive per month than term policies, but your payments are put into an account which grows over time in addition to the death benefits. Now, we're gonna dig deep into this and really explain exactly how that is and what that looks like. Okay, so first let's talk about whole life right now. Unlike term insurance, you keep the money you pay into your whole life policy. Each premium payment goes into a tax-secure vault, which gives value over time through interest. Think of whole life insurance like an ultra-secure retirement account. Death benefits are, for the most part, an added bonus, but not the main reason to get a whole life policy. So check it out, folks. A 401k is not a tax savings, but it's rather a tax postponement that results in substantial lost opportunity cost, limits your investment choices. And oh, by the way, if you become disabled, it doesn't make those payments for you. Everything I just said, the opposite is a whole life policy. Not only does it grow and come back tax efficient, you do get disability coverage. And at the end of the day, you have the ability to be able to touch that money during your wealth accumulation phase to put it to work somewhere else. All right, so let's talk about leveraging your policy. The unique benefit of whole life insurance policies is that you could use them as collateral for loans directly from the insurance agency. This easy credit allows the policyholder to quickly obtain cash for investments without ever having to visit a bank or withdraw from their own assets. So check this out, and this is important that you follow me on this one. At the end of the day, as your cash value grows and as your cash value begins to accumulate, you could then leverage that and go buy a piece of real estate. For example, let's say if you have $200,000 built up in your cash value and there's a $400,000 piece of property you want to buy, and your money is growing inside the policy, you would borrow $100,000, right? You're going to be charged a certain interest on that. On the overall piece, you're still earning a rate of return, so it's uninterrupted interest. Now you get 4 different rates of return in the real estate you bought. You bought a $400,000 property, you put $100,000 down, have your renter pay back the policy over the next 10 or 15 years. On that down payment, you become like a bank. You also get to depreciate the asset on your tax return. You also get to have a mortgage interest write-off, and you're buying a property today, real estate, to sell in the future at a higher price. In that scenario I just described, between the whole life giving you dividends and interest, and then the 4 rates of return inside the policy itself, plus paying back the policy, that's 7 different rates of return off the same dollar. This is where the leveraging becomes so powerful. You may say, Rob, I don't want to do real estate. Okay, hard money lending, finance your own debt, or buying other businesses. So as I described that, a lot of times people say, I don't really understand it. It doesn't really make sense. How do I borrow money from my policy and it's still going to earn a rate of return? So here's a really good example. Whole life insurance acts like home equity. Check this out. Banks will give home equity loans based on how much a borrower has paid into their existing mortgage. The bank uses the deed to the house as collateral to keep guarantee repayment of the loan. Whole life policies offer similar lines of credit, but with less strings attached. Now, if I'm going to borrow from my home has to be, I have to have a lot of equity in it. If the real estate market goes down, even after I borrow it, that becomes a risk on what I borrow from my home. Whole life never goes down. So as I borrow from whole life, the collateral is the cash value inside the policy, but that still means I'm earning a full rate of return on, because it's non-direct recognition, I'm earning a full rate of return on my money even after I borrow it. Okay, let's talk about why policy loans trump home equity. If the market's going up, it's easy to borrow from your house, or it's easy to borrow from your S&P 500 account. But when it goes down, that's where it gets tricky. And at the end of the day, we talk about it often. Policies work, whole life policies work under any circumstance, provided you're following the rules of funding it the right way. So number one is flexibility. Whole life policy loans offer much more flexible payment plans than anything offered by the bank. Custom funding for a custom life. You could strategize it any way you want. Number two, banks are notorious for dragging their feet. Policy loans require very little paperwork and provide cold, hard cash within 48 to 72 hours. Number three, low risk. Unlike real estate, a whole life policy cannot be taxed or foreclosed on. It can lapse though. Your agency can only reduce death benefits as leverage, nothing more. It can lapse if you don't make the payments or the interest payments back into it. But the point is, by doing this and understanding the concept of whole life, not for 1 or 2 years or not for just an up market, but over a 10, 20, 30-year period, if it's part of your overall financial planning strategies where you want to get multiple use of each and every dollar and have uncorrelated assets work with correlated assets, well, that's where the magic touch happens, and that's where you could really understand infinite banking and become your own bank. Okay, guys, warning, because a specialist is no doubt required. There's so many different policies that are out there. And then if you find the right kind of policy, it has to be overfunded the right way in order to really match and mirror what this strategy actually looks like. Like any financial system, a whole life insurance policy needs to be set up correctly. Most agents are trained to max out the death benefit and lower the premium payments. This dramatically reduces the ability to leverage the policy. It's important that you understand that there's all different kind of policies. And then even when you find the whole life, there's different whole life policies. So when your agent does a traditional policy, they make commission, their sales manager's happy, their GA's happy. When you overfund it early, that's less money for the agent, GA, and sales manager. So it's important you understand that a traditional whole life policy means you can't leverage that cash value till year 3 or 4. The way we structure it is that you could leverage that right away because we overfund it early and often. Usually at this point, people say, Rob, this sounds too good to be true. I don't know how to do this. Do you know someone that does it? Can you help me out? Go ahead, click the link below. One of the team members here at Epic will take you through that educational process. Once again, no obligation, really genuinely show you the difference between an overfunded and a traditional policy. And when you see that, you'll be able to see the major difference. So thank you so much for watching and subscribing and being part of our channel. The infinite banking strategy is something that can change your life for the better if you follow A through Z exactly what we do. Continue to follow, like, and subscribe. And at the end of the day, check out this other video.